And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Good morning and welcome to the show. Of course, it is Tuesday. It's also Two Dads on Money. Talking today a little bit about kind of a year-end checklist for investors and also some other kind of topics around just financial management. Get ready to wrap up the year. There was a very interesting analysis out the other day, and I posted this on Twitter, X. In 50 years, I will get it right. But I posted this analysis out, and it showed wealth by brackets, by quintiles, right? And what it was interesting about this is it shows that, we talk a lot about the wealth gap, and what's interesting is that when you look at this analysis, kind of the bottom 50% of the economy, the bottom 5 quintiles, all their net worth is in their house. Now, if you start looking at the upper quintiles, this is where we talk about the wealth gap, most of their wealth is in investable assets or businesses, right? So they're investing capital, making that capital work versus being tied up in an ongoing expense. And this is one of the big myths about home ownership. We drive a lot of young people as we say, oh, you need to be able to buy a house. And of course, lots of headlines about housing unaffordability. It's so unfair, I can't afford a house. Don't worry about buying a house. A house is an expense. It's not an asset. It's not an asset. It doesn't grow wealth, because even if your house appreciates in price and you sell it, that's great. You've got to go buy another house to live in. So you don't really create wealth through housing unless you're doing, buying rental properties, those type of things. We're talking about primary residences. So if you really want to work on building your wealth, focus on investing assets, building a business, those type of things that create income and create wealth over time. And again, look, there's a lot of money to be made investing in real estate, but that's on the investment side. So again, we're talking about, people that have their entire net worth tied up into their primary residence, right? So, it was kind of a very interesting analysis. I'll try to show you that chart here in a few minutes if I can find it for you. But outside of that, it's also very important today to note that today is let me rephrase that. Today is very important because it's anything covered in chocolate day. Oh. So that's right. John, what do you think the number one thing dipped in chocolate is?
First thing that came to my mind is strawberries.
Alaska. Brent, you got to pick. Number one thing dipped in chocolate. That's not the right answer.
Peanuts.
Peanuts. Nope. That's Georgia Southwest. No.
Okay.
Number one thing dipped in chocolate. Bacon.
What?
I wouldn't have been close. No.
Bacon. It's sweet, savory. It's the number one thing that people like dipped in. I thought it'd be like pecans here in Texas, right?
Yeah,
We're famous for pecans, but it's not. Cherries is up in like Maine, not in Michigan.
Yeah.
So, but bacon, mostly Midwest. But number one thing dipped in chocolate, bacon.
I shall have to try it.
It's sweet and savory, I guess, right?
Yeah,
so, anyway, go dip something in chocolate today. That's the real thing, or just eat the chocolate. So,
peanut butter on it.
There you go, peanut butter on it. Yes.
All right, welcome back to the show this morning. Like I said, Michael Lebowitz joining us in studio.
Out of my bunker.
Out of your bunker. It's an amazing thing. Be sure, and Michael Lebowitz, by the way, will be at the Economic Summit coming up in January. So again, tickets are selling a lot more quickly this year than they have previous years. So again, if you haven't got your tickets yet, be sure and swing by the website, realinvestmentadvice.com. Get your tickets. Mike will be there. We're going to have a mixer the night before. So if you want to come hang out with Mike for a bit, talk to him, you can buy a ticket for that as well. So again, we're going to have lots of really good events. The whole presentation lineup is going to be really good this year. So again, look forward to seeing there. Like to meet all of you. So again, get by the website, realinvestmentadvice.com, get your tickets, and we'll see you there. It's January 17th.
We should be paying them to come and talk to us.
Probably true, but don't put that out there.
I won't. Keep that on the down low, everyone.
Exactly. So, all right. So a couple of things, Mike. I saw an interesting kind of poll out this morning that now have 80% probability that Kevin Hassett will be the next Fed chair.
Correct.
And markets don't like that. Or do they like that?
I think they're trying to figure out what they like. The thing with Kevin Hassett is he's pro-growth. He's a supply-side economist, which means he's going to push for probably lower rates. That's why Trump wants them.
Right.
And we know that. That's kind of a known commodity. But he'll push for more deregulation of the banking sector, so lower capital. That's pro-growth. So what I think the market's grappling with is right now we kind of have this tug of war between, do you support the labor market and are you worried about inflation? And the Fed's kind of towing that line. They're not being too aggressive cutting rates because of their concern about inflation. The risk is that we get someone in charge that becomes more pro-growth, less worried about inflation. They just assume inflation is going to come down. Then the market gets worried that inflation is not being cared for properly. So, Powell's not leaving till May. Hassett, first of all, hasn't even been nominated. He hasn't been voted in. There's still a long road ahead of us. And look, by the time we get to May, inflation may not be a concern, and Hassett may be the right person, or inflation may start going back up again, and Hassett changes his tune, or it's just not Hassett, it's someone else.
Right.
So
look, that is a good point. Is that that's a long road between now and next May.
Right.
So there's a lot of stuff that can happen.
It's not hard for him to screw up and say something that Trump doesn't like.
Exactly. So so again, there's a lot of things that can happen between now and then. But it is interesting. I mean, there's Kevin Hassett seems to be more of a polarizing character. In other words, there's people that like him and then there's people that hate him. There's not a lot of people in the middle.
Right. And, we'll just see how he can get through, assuming he gets through Congress. Do his views change? And he's only one member. He's only one voting member. He has the most sway, but he's one member of 12 or so that vote. So it's, even if you're very scared that Hassett's coming in and he's going to push rates a lot lower and not care about inflation, that's 1/12 of the vote. So, it's, I think it's something the market's thinking about, but it's not maybe some of the recent weakness in bonds, which hasn't been all that much, but, call it consternation in bonds.
Yeah, I say like bond yields haven't gone anywhere.
No,
for like 6 months.
They
They're
stopped
just
drifting
stuck.
lower. It was kind of like what you just showed with the stock market. It's consolidating.
Yeah. So, but that kind of brings us up to kind of your article that you wrote on Wednesday too, which was talking about the end of kind of this group think that's been going on with the Fed. And, now you're starting to get a little bit more dispersion in outlooks when we get the dot plots, right? Especially with Steve Moran now on as a voting member, we're starting to get more of a dispersion in the dot plot. The dot plots used to be very, very like just a cluster of dots. They were all very, very close. We're starting to see more of a dispersion in those dots. And that was kind of the point of your article is like, questioning this idea is that maybe they're just, this kind of group think is finally starting to end. Well,
it was interesting. A few weeks ago when I got the idea for the article, the Fed voting members were being very outspoken about, I'm going to vote for, they're going to vote for a cut. They're not going to vote for a cut. Normally they just kind of weigh the pros and cons, but they don't really tell you what they're going to do. This time, a lot of them were kind of telling you how they were going to vote, and the vote was more or less split up the middle. Some, about half voting yes, half voting no, and a few kind of didn't know how they'd vote. And if you kind of think about it, if they were taking a vote that day, there could have been 4, 5, 6 dissenting votes. Typically, I ran the numbers back to, I think it's 1936, and on average, there's half of a dissenting vote at every meeting. There were 2 at the last meeting. One wanted to go 50 and one wanted to not cut rates. That was a lot at 2.
Right.
So if we're starting to talk about 4, 5, 6 people at some of these meetings dissenting, it's kind of telling me that the chairman is losing the ability to form a consensus opinion. And I think that's a good thing. The Fed has not been great with monetary policy. So I think what it would be really nice to hear from the Fed is we're cutting rates, but 4 of the people said they didn't want to cut rates because of this, that, and the other. It's not a majority, but it is enough to cut rates. We'll cut rates. I think having those different views and allowing them to dissent, allowing them to speak their minds, just gives investors, gives the world, consumers, business leaders, a better take on what's really going on at the Fed, as opposed to this, we're all on the same exact page. Because it's monetary policy is to some degree like predicting the weather, and you just don't know what it's going to be the next 3 days.
It's very close to predicting the weather, and most weathermen are wrong after 3 days.
Right.
So and that's the problem. But it also kind of is an interesting thing, because if let's just say, for instance, we have a vote that comes out, and let's just say it's 6-4, whatever, right? So it's close. There's enough of a majority to cut rates or raise rates, whatever it is, but it's close, right? That could potentially weigh negatively on the economy, because if the economy, to your point, if consumers and business leaders and those type of things are going, okay, hey, great, you cut rates, that's good for my business, right? I can go refinance, I can go build a rental property, whatever, because I've got lower cap rates, et cetera, whatever. But that vote is very close, maybe, because maybe at the next meeting they talk about hiking rates. So maybe I don't go I don't make capital expenditures. Maybe I don't go make purchases because of this non-consensus that's going on. So, I mean, is it possible that could also backfire by them not being more cohesive?
Well, let me ask you a question. Let's say that's the case, and but they all vote the same way. But there's half of them are thinking we really shouldn't be cutting rates, and maybe we should be raising rates. If you were going to spend money, wouldn't you rather find out at that meeting than 3 weeks later when they start speaking? So, I guess all I'm saying is just be honest with your views. Just let us know. Now the risk to this is it becomes a little bit like the Supreme Court, where it's very, very politically driven, where you have your hawks and your doves and your Democrats and Republicans, or however they're going to split up. It can just split up by economic theory, politics, a whole host of things. And there's or Congress, where it's always a 50-50 vote, and it's not based on the economy. So it can go a number of ways, but I just think honesty and expressing the views is probably best for economists, for investors, for consumers, for business leaders.
How about this for an idea, Mike? How about we go back to the way it was before 2000, and they just shut the hell up?
That would be nice.
And we don't hear from them, and we don't know who they are, and they're just kind of pulling some levers in the background with the banks, and they just stay out of the markets and let the markets. What about that idea?
So two more things.
All right.
Hassert does want more open communication, so that foils that idea.
I think we need less.
But he wants formulas, things like the Taylor rule or other mathematical formulas.
And look how well those have worked.
Rate.
Yeah, let's look at those models they've used and look how well those have worked over the last 20 years.
Exactly. So, I unfortunately, I do hope that they do express their views, and that there are opposing opinions, and they're allowed to vote the way they really want to vote. They don't have to feel like they have to form a consensus. I think that's a positive. But at the end of the day, I'm not sure how much will really change with the Fed in their ability to do the right things.
Yeah, I'm going with the Dave Chappelle theory. Hey,
What's
why
that?
don't you shut the fuck up?
I second that.
Yeah, but anyway, but it is interesting. I mean, just from the standpoint that, this is what the markets have now gravitated to. Again, as I was saying, pre-2000, really, you go back to the 1990s, when you and I were first getting started, you go down the street and ask somebody who the Fed chairman is, I have no idea.
Right.
I mean, they were just this kind of anomalous people that were out there somewhere. We knew there was a Federal Reserve, but knew nothing about them or what they were doing. Paul Volcker back in the 70s was probably the most notable guy, and most people didn't even know who he was. Right. Except now in history, we look back and because it was Volcker and Reagan, so we know what was going on back then. But, after, Alan Greenspan, and really, the late 90s and really early 2000s, all of a sudden the Federal Reserve became this big prominent figure. And now the markets are just attached to them. And it's not just the professional market traders, right? It's now every retail investor is looking at the Fed. It's like, oh, they're going to cut rates, or they're not going to cut rates. Let's look at what happens when they cut rates to the markets. Markets go up because of more liquidity. And so we've got this whole market now. And again, this has been the case over the last 3-4 years, is that, we're going through a correction in 2022 as a good example. Markets are declining. We're working through a reversal process, which is great, good, healthy thing for the markets. But we're getting these boomer rallies on expectation the Fed's going to stop. Oh, is the Fed going to stop cutting rates this meeting, right? Oh, no, they're not. Okay, so we sell off again next meeting. Are they going to cut rates? So we run it up into the meeting. but every meeting now has been a driver for the markets.
Well, I mean, it's all about liquidity.
Yeah.
And the Fed has taken, this was my article from a week or two ago. And by the way, I'm done with the Fed. I think this is 3 articles in a row. I will move on to something else next week, I promise.
Good luck finding a topic.
Well, that is the problem, because it all starts with liquidity. And since 2008, the Fed has kind of taken over that liquidity doling out process. Now, maybe that will change with capital requirements, with some other things, but that's the problem, and that's why we have to spend so much time on the Fed. Do you remember on Thursday afternoons they would release the money supply?
Yeah.
That would be the big announcement. And that was the signal as to kind of what the Fed was doing. But at the time, it was banks and mutual funds and money market funds. They were the ones supplying liquidity to the markets, and you never knew how much they were supplying or what their views were. One big bank may have been supplying a lot. The other one may have been pulling back. So there was not this dependency on one entity to tell you how much liquidity would be coming into the market. Now we have, it's not just you get a QE number, a QT number, their balance sheet number every day. You could see what reserves are. It's like we have these real-time measures of liquidity, whereas we were flying blind.
Yeah. Well, and again, that kind of brings us to kind of where we are right now, which is, so the Fed has now ended QT, and we're going to the meeting next week. So we're, I think there's an 80% odds right now we get a rate cut next week. They've ended QT, and just over the last week or so, they've injected a big chunk of money into the repo markets as well. So, again, we're starting to see that liquidity concern in the markets. What's that telling us?
Yeah, so liquidity is strained, and we can look at reserves. There's quite a few charts we could see. We could see how some of these overnight money market rates are trading versus each other. That there are trades that really shouldn't be happening. There's free money to be made by lending to some entities, but they're not lending. So, the markets are telling you there's some degree of stress. And honestly, Lance, I think Bitcoin is one of those markets. It's very speculative, and I think it's kind of liquidity stress that's holding it back. If you chart the change in Bitcoin and the change in reserves or the change in a monetary base, they have a very high correlation. So it might just be that Bitcoin is just a surrogate for liquidity.
Right.
Shocker.
Well, again, it's whenever you have assets in general, right? They tend to start to migrate, and it depends on who's trading them, right? If you're getting a lot of institutional trading, those type of things, hedge funds, et cetera, then they're going to start kind of correlating back to liquidity settlements. So,
and I think the more speculative, the more it's tied to liquidity.
Yeah.
So, Procter & Gamble, much less tied to liquidity than NVIDIA.
Right.
And NVIDIA less so than Bitcoin.
Right.
And you can go up and down the line. Recently, I don't think gold, silver have been extremely tied to liquidity, which is a little interesting. I think they were for a while, but that correlation is broken off. So, I think what this really leads to is possibly a prolonged period of consternation, consolidation, where the market may be trending higher, maybe a little lower, but not really jumping or falling unless liquidity really becomes problematic. But then it's a question of, when does the Fed come in? When do they really start up QE? I actually saw one of the Fed members, I forgot the word, but they were talking about reserve management. It was something reserve management. It's called QE. Right. They're going to try to disguise it.
It's just a different word for the same thing.
Well, if you remember in 2019, they started QE, but they were doing it on Treasury bills, and they were saying, "Oh, it's not QE."
Right. It's not QE.
It doesn't matter. If you go to a candy store and buy candy, whether it's for 50 cents or $5 or how big or how small it is, you're buying candy, and that's QE.
Right. And again, we'll see how this will. Again, I'm anxious to see this next meeting now that they've stopped QT, because again, I'm just wondering how long it's going to be now before they start talking about some form of QE.
And what's interesting is, this all kind of started post 2008. They put more and more capital restraints on the banks, and basically in doing so, the Fed had to become the leader of doling out liquidity. So, over time, they've had these mini crises and they've had these issues, and they've built these other programs around it that are caps and floors and like safeguards, bumpers. And, so I think the Fed's like, well, we have all these programs. So, yeah, there's a little stress, but we have all these things working. I think we're good. Let's see how they work. But inevitably, they probably at some point do fail. It's a matter of time. And the question is, how much do they trust these programs, or are they going to want to just start insuring themselves with just a little QE or some other program that puts liquidity back in the market? Because right now it seems that even though they're stopping QT, reserves are still going to fall on the margin. Maybe not as much as they would have,
right, but
they're still going to fall. So that's just slowly putting more stress on the highly speculative ends of the market. And, one of the problems, Lance, is that the Magnificent Seven are kind of controlling the market right now.
Right.
And a lot of them are highly speculative. So this isn't like your days of Exxon and Procter & Gamble running the S&P. So,
yeah. Well, it was just like yesterday. I did an interview on Fox Business yesterday afternoon, and they asked me about Oklo, and because I said, it's probably it's down 50% from its peak. It's had a huge correction.
Right.
And I said, it's probably good for, a trade into year end. Wouldn't be surprising. It's decently oversold. If the market rallies into year end, it's probably going to get a nice little bump into year end. And she had the host asked me, he's like, well, why just a short-term trade? I said, because they have no sales. This is it's a great thesis that Oklo is going to build all these nuclear power plants. May very well be the case, but right now they have literally no revenue. They have all expenses and no revenue. So at some point they've actually got to start generating revenue, and when they actually start generating revenue, it's a different story. But it can be a very long time between where we are today and them ultimately getting a nuclear reactor up and running and actually making revenue.
Well, more problematic. It's a long time, meaning they're going to take on more debt, meaning they're going to take on more losses that have to be funded with debt.
Yep.
So there's a long runway, and can they take off, or will the plane pop a tire
or does something else come? Does some other company come along, or like Constellation Energy Group or GE Vernova? Whatever, there's a lot of other companies potentially in that space as well.
Or you could just buy a boring natural gas pipeline company that is already making money and is supplying the natural gas to power these data centers.
Yeah.
But that's too easy.
Yeah, exactly. Well, it's going to be, this is going to be one of the interesting things that's going to come up is that, we talk about, and I posted a tweet about this morning. I said two things about these data centers, because if you look at the ramp of power usage that these data centers are going to require, it's exponential over the course of the next 5 to 10 years. So be ready for higher electricity costs at your home.
Well, it's already happening.
Yeah. It's going to get worse. And the question is at some point, when do those powers that be start to figure out that pay their fair share is going to have a very different meaning in the future, right? We went through this whole thing where the rich need to pay their fair share of taxes. The question I think is going to ultimately become is, when are these data centers going to pay their fair share of the electricity costs?
Right, and I think that's coming sooner rather than later, possibly with the next set of elections.
Yeah.
Because I would imagine that some people are going to run on that. It's like, why are we paying for the data centers? So Amazon and Meta and all these other companies can make these enormous profits so that these billionaires can become multi-billionaires.
Yeah.
It's all part of this kind of populist movement that's been going on for a long time now, and it will probably just
and look, and I'm just wondering if Meta turns into the next Enron now that they're getting into power trading. So I'm not saying that, but I'm just saying, last time we had a company speculating in power trading, turned out not so well. Anyway, I got an email yesterday from one of our listeners that asked a couple of questions, actually 3 questions here. And the first question was what do you think about the impact to the market if the court decides against tariffs? This is that the Supreme Court should decide on tariffs by the end of this year, whether or not. And so the question before the court is simply this: did President Trump have constitutional authority to impose a tax on foreign countries? That's the only question. Was it constitutional or not? So if they rule against that, which I think there's more than a decent probability that could be the case, saying, no, you didn't really have the authority to do that, that's then going to kick all these tariffs back to Congress. Congress is going to have to pass a bill to keep these tariffs in place. If they don't have the majority to pass the bill, then there's some potential other outcomes. We may have to refund tariffs. There's a lot of other potential consequences. So the only question between now and the end of the year is, did he or did he not have the authority to use executive powers to issue a tax? Because taxes are a function of Congress. They are the ones that control the purse. They're the ones that have to, if there's going to be an increase in tax, it has to be passed through Congress and Senate, signed into law, those type of things. So that's the big question. So do you think the markets react positively or negatively?
I mean, it's a good question. I think what makes that a little harder is that Trump will work around it. And he has said there are many ways that if it fails, I think Trump's setting up for a Supreme Court to rule against him. So what will he immediately come out with that basically reinstates him in another form? And because of that, I'm not sure the market reaction will be that big. In theory, it should be positive for stocks and bonds because tariffs were negative. So you should have the opposite, although the stock market's been up a lot.
I was going to say, despite the concerns about tariffs are going to cause this massive wave of inflation and all this that never occurred.
Well, here's what happened, right? We're going to put 50% tariff on China. Trump would come out and say that. The market drops 2-3% in a day. 2 days later, he comes out and says, just kidding, 20%. The market rallies. So I think the market has kind of shown you that it prefers no tariffs to tariffs, right?
Right. Or at least lower tariffs.
And we know the bond market has this concern that tariffs are inflationary. So, I think on the margin it should help. But again, I think it really matters. What's Trump going to do if he loses? How will he work around it? Will Congress work with him? There's starting, to be a little division within the Republican Party. Is that enough that he couldn't get bills so easily through? Yeah. And what do the deals even look like? Because most of these deals aren't signed agreements yet. They're just, paying in advance of what they think it'll be. So, it's kind of like Hassett. There's a lot we don't know, and there's still a lot of time to digest it all.
And kind of going back to Fed rate cuts, the other question that was in this email was asking about, what would be the impact on the dollar? So if the Fed cuts rates, is that good or is that positive or negative for the dollar? There's still a lot of this idea out there that the dollar's being debased and that the dollar's going down in value and those type of things. Yet the dollar's been, and you've heard less of that lately because the dollar's been rallying again, which is not surprising. But if you start getting Fed rate cuts, historically, is that better for the dollar, or what do you think?
It's the dollar in relation to every other country. Most countries have been, not counting Japan, have been cutting more than us. So we start catching up, which is kind of funny. The dollar has been getting debased, quote unquote, right? The dollar's been falling. It's down, 10-15% this year. And we've been more hawkish. Our Fed has been more hawkish than the European central banks and most other central banks, China too. So, it's I think it's a tough decision like everything else. I'm not sure which way Fed cuts will really cut. I think it comes back to that original argument we had about Hassett is growth or inflation. And I think if inflation can start coming down, a lot of the fears, which will help the dollar, will go away.
Yeah. Well, and two things that'll happen also too if the Fed cuts rates is that should help support the markets. That should also help kind of the economy on the margin. So a stronger economy, stronger stock market, that's going to drag more foreign assets into the U.S. dollar. So it should actually wind up making the dollar stronger. And again, this is kind of an interesting comment. Back to our comments. There was all this concern this year that nobody wants U.S. stocks, nobody wants U.S. bonds, nobody wants to be in the dollar, et cetera. And there was actually a really, really good chart yesterday. This is the 2025 flows globally into stocks, bonds, and credit. And by far and away, so again, if I buy U.S. stock, if I'm a foreign investor and I buy U.S. stocks, I'm investing in the dollar. So everybody invested in the U.S. stock market this year. Bonds, by far and away. You've got almost $500 billion worth of bond flow this year into U.S. Treasuries versus kind of the rest of the credit market. So again, these are the problems with these narratives, is that just because something's declining in value doesn't necessarily mean it's the end of something. It's we have stocks go down in value doesn't mean that every company's going bankrupt now. It's just after a big rally, they're going to have a correction, and then you're going to get a rally again.
Well, let's talk about the bond narrative we were talking about a year ago.
Yeah.
Last time I was here.
Yeah.
A year ago, the bonds were about, 50, 75 basis points higher in yield because the deficit was a huge problem because inflation was raging. Well, inflation has kind of stuck around the same level it was back then, right? Mm-hmm. The deficit hasn't gotten any better, and it's probably gotten a little worse than people thought it would be. Yields are 50 basis points lower. It's because that narrative has faded. Mm-hmm. It was never a great narrative to begin with, but it's gone.
Right.
And it's the same with the debasement trade. That narrative that the dollar's going away and we're going to be using euros or Bitcoin or gold or whatever it may be it's already fading. You don't hear it nearly as much as we did a month or two ago. Yep. And that'll be gone. There'll be new narratives that take its place.
So I have a rant I want to finish up today on.
Okay.
I read this article. I wanted to get your. I saved this article specifically for today.
Oh no.
Well, because you've got 3 kids.
Yep.
Right. I've got 4. I had 4 that were young. I still have them. I didn't get rid of them.
They're off the payroll to some extent.
But they're off the payroll, right? They're on their own. And what's funny is they all now, before when they were growing up, I couldn't get them out of bed till like noon, right? Yeah. And now they all get up at like 6 in the morning and they're good to go for the day, right? So there's just, anyway. But here was this is a new nationwide report from Amerisleep.com, and it highlights a growing problem facing parents and students. American school mornings are becoming harder than ever, even as science continues to warn that early start times are harming children's sleep, mental health, and academic performance. To understand what mornings look like in households across the country, Amerisleep surveyed 792 parents with children in preschool through high school. The results show families are stretched thin, waking early, scrambling through long routines, and fighting fatigue before the school day begins. The findings arrive... Brent's over here with his small violin. The findings arrive at a time when states are deeply divided on school start times. Okay, so here's the issue. So schools start between 8 and 8:30, right? What time does your school start?
The youngest is 7:55.
Okay, 8 o'clock.
The other 2, so we have 3 in 3 different schools now for the first time. The other 2 are 8:50.
Okay, so between 8 and 9 o'clock.
Yeah.
All right, so 8 a.m. and 9 a.m. in the morning. So parents have to, so here's the challenge. This is where I had to laugh, considering I get up at 3:30 in the morning.
Yeah.
Amerisleep's new data paints a clear picture of the preschool day rush. Parents wake up at 6 a.m. on school days. They spend an average of 47 minutes getting children ready. 48% of mothers and 35% of fathers say they feel morning fatigue. Drink a cup of coffee, okay? 37% of moms and 30% of dads say they need a break from the school morning grind. 42.9% of parents say mornings are difficult, and among those struggling, 76% report delays, often from sleepy kids and parents exhausted from the night before. Hey, here's a clue. Get your kids off social media, before they go to bed so that they don't have the blue light keeping them up all night, and basically have them shut down their phones so they actually go to sleep on time. That might be a good start.
Yeah. I feel like I need Michelle in here for this one. No, I agree, and I do think start times are odd with kids, right? Especially if they do need more sleep when they're young, yet we do have them starting. So think about this. If I want to put my kids on the bus, mm-hmm. It's going to be, I think the bus comes like 6 something.
Yeah.
Right? So no, I mean, it's something that's achievable. What drives me nuts is, the kids want to sleep in on the weekday, okay? And they like school. But on the weekend,
they're up crack of dawn.
6 a.m., it's like
they're
before the sun, they're ready. They're waking us up. If we're not up already, It's like, go back to bed. But, multiple times having to get them up. And so there is, I can understand the fatigue aspect of it because especially with multiple kids, look, it's life though. That's the stage you're in.
Thank you.
And
and look, do some things like set your kids' clothes out the night before, right?
Yeah.
It's not hard.
I mean, we have a constant battle.
Have the lunches packed the night before, right?
And that's a constant battle, right? I mean, our kids are very busy with different sports and activities. And so by the time they get home, they do their homework, get ready for bed. They're getting up and, hey, guys, everything's laid out. Go make your lunch. Get all your stuff together. And, some days it's really good. And when it's great, it is great. But, man, when it's bad, it's like, this. You're 12, 11, and 9. Like, I'm not making your lunch. Go do it. You know what's for breakfast? Well, I don't know. If you complain about, one of them's going to complain about something at all times.
Sure.
You know this with 4, right?
Absolutely.
You want to go out to eat? Nope. Hate that place. Like, what? You loved that place last month. No. Just on principle, one of them has to always,
absolutely
throw a monkey wrench into any plan. And so inevitably, same things with breakfast. And so we've kind of got to the point like, all right, here's your available options. You figure it out.
Yeah. And that's what we did with our kids too. They got up, and this is the thing that when we were sending our kids through school, right, is that we woke them up at 6:00, and basically they had to take care of themselves at that point. And then literally, if they came out in their PJs and didn't get dressed, they were on the bus on PJs.
Yeah.
And you know what they learned? They learned the next day to put their clothes on so they didn't have to go to the bus on PJs.
Yeah.
Right, or whatever. And so, this is, and again, it's just about teaching kids discipline. And, our kids had to go to bed at a certain time. We shut off social media. They didn't have access to those things. I shut off Wi-Fi every day.
In the house? So we don't have that problem yet because they don't have phones.
Right. So, but yeah, we just shut off Wi-Fi. And then until they did their chores, they couldn't get the password. So, it was just, but you just had to establish discipline. And by establishing that discipline, you take all that stress out. The problem is again, what are parents and kids doing at night? They're staying up till 10, 10:30, 11 o'clock at night, watching TV, YouTube, whatever it is. They're not getting enough sleep, and then that makes it hard to get up in the morning. You could move the start time of schools till noon, and say
still be a problem.
And it's still going to be a problem.
2 or 3.
Yeah, it'll just all you'll do is just shift it. You're not going to create a solution by adjusting the start time. You've got to create the discipline at home and the structure to take that stress out of mornings.
Yeah, I do think the start times for schools are kind of interesting because you have them staggered, which I can understand if you have multiple kids, you have to get them there. But you also, some of them are kind of funky. Like our middle school or intermediate and junior high are on the same bus, but they're 2 different places. They're not like right next door. But then high school starts at 7 a.m. or 6:55. And those are probably the kids that you could argue going through puberty that probably need more sleep. It's kind of backwards if you think about it. Well, and they could drive themselves anyways most of the time.
So the CDC says that kids need 8 to 10 hours of sleep. Mm-hmm. Okay, that's fine. That's reasonable.
Mine get that.
Yeah, of course. 70% of high school kids do not get that much sleep on school nights, which means that on the weekends
they're staying up.
Exactly.
Yeah.
Because on weekends they're apparently getting plenty of sleep, right? Because they're sleeping until noon or whatever. But again, it's about discipline, structure, those types of. But the funny thing about this and why I laughed about this when I read this article was because, every parent I know that's raised kids has gone through this. We all struggled with the mornings. We all struggle with this. And guess what? We survived. It wasn't the end of the world. We didn't need to go adjust school times to make things better. We just adapted to it at home and made it work.
The interesting thing is that study shouldn't have been on the kids. It should have been on the parents.
Yeah. Thank you.
Like, they got it backwards here. Kids are sleeping fine. It's the parents that don't get any sleep.
There you go. All right. Anyway, that wraps up the show for the day. I just had to get that in.
Yeah, no, that's a good one.
All right. realinvestmentadvice.com. Make sure go to that website. Click the link. Get your tickets to the upcoming summit, January the 17th. It's going to be a really good event. Tickets are on sale now. They are selling out pretty quickly. So be sure and get your ticket now if you want to come. We do have a block of rooms. If you're coming in from out of town, would love to visit with you. So again, get your tickets now at the website, realinvestmentadvice.com. See you back here tomorrow.